Hello and welcome to youshallpass.com.
Hi and welcome back. This is the third and last video in the LOSs 1 and 2 series. Carrying on from where we left off in the second video, we'll be finishing off all the sample questions of the curriculum readings here. Hopefully by the end, you will be very comfortable with the congruence and the overlap that the rules of My Way have with the CF Institute's Standards of Professional Conduct, and you'll also be quite proficient in the use of the rules of My Way in practical investment situations. As always, have a hard copy of the rules at hand. Good luck. Smith's position on the stock is unlikely to be compromised by either choice A or choice C, because the nature of the relationships described in both these choices is so tenuous financially, and the financial incentive to cheat in her report is so flimsy as to be almost non-existent. Besides, what sister-in-law ever liked her brother-in-law so much as to talk up the company he does business with? If anything, it would be the other way around. Smith would be shouting out, JNI Corp is so bad, they do business with my brother-in-law. So A and C are fairly straightforward eliminations. On the other hand, fluctuations in the share price of JNI Corp can lead to considerable benefit or loss to XYZ, since they have a substantial position in JNI stock. So that's a much bigger incentive to talk up the share price or prevent it from falling. So there's a much more substantive conflict of interest there. This question revolves around standard 6A, disclosure of conflicts. That there has been a violation is evident, because Michelou is not disclosing the correct state of affairs, the correct situation to his prospective client. Option A, saying that no violation has occurred, is out. The rules of My Way in general require that the truth be spoken and facts be represented as facts and opinions as opinions. So Michelou has not. What he has done is he's not guaranteed results either. He has not said that he will earn 26% for this client also going forward. But what he has done is something more general and subliminal and more deceptive in nature. What he has done is that Michelou has made himself appear a far better investment advisor than he really is, without guaranteeing results. So C can be eliminated as well. And with the elimination of choices A and C, what we're left with is B as our choice of the correct answer here. This question relates to standard 1C, misrepresentation. Well, the rules of my way, rule number one, states that none of the effectees of your actions should feel hard done by. And in this case, the investment banking department and the brokerage department have their own clients, and the clients of both are entitled to the best advice and the best service. And neither should either department have an edge over its competitors in other firms, simply because they happen to be in possession of a piece of information that is not available to everybody else. So, these conditions where there are no conflicts of interest and where both departments are performing their duties independently and objectively and without any coercion, and where their clients are receiving independent and objective advice, and nobody has an edge over their competitors due to inside information. This can best be brought about by blocking the exchange of information within the two departments, blocking the exchange of information between these two departments. And that is what option B says. So we're going to go with that as our answer here. This question was about standard 2A, material non-public information. Well, I suppose this is an easy one. The people directly and most affected by the investment performance of Goodness Pension Plan are the plan's participants and beneficiaries, and they are stewards' real ultimate clients, and all stewards' duties of loyalty, care, prudence, objectivity, independence, marital fidelity, etc., are all owed to the plan participants. This question was about standard 3A, loyalty, prudence, and care. Well, choice C appears to be a straightforward elimination here, because the referral arrangement is being disclosed to the client once the client is already on board instead of beforehand. It doesn't make sense. I know that rule number one says that whenever conflicted, disclose, but I doubt that the intent was for the client to start acting cheap once the disclosure is made. Rule number one does intend that all participants of the circle of life should be safe from malice at the hands of the member, but by the same coin, the member should also be safe from malice at the hands of the other participants of the circle of life. So I think one can safely say that the intent is not that the client should request discounted services once disclosure is made. So that's choices A and C out, and with these we are left with choice B as our choice of the answer here. This question was about standard 6C, referral fees. This appears to be another one where the correct answer jumps off the screen at you. Rule number one: Whenever conflicted, disclose. Disclosure means option B. Case closed. Well, rule number 1 says that don't do to others what you wouldn't want them to do to you. In this case, members should not poach clients from their employers before jumping ship themselves. And while they are in the employment of an employer, all their efforts should be directed for the benefit of their employer and not for themselves or for any prospective employer. So this means that option A is a straightforward elimination. Option B appears correct to an extent, in the sense that yes, Jackman's incentive scheme incentivizes employees to poach clients from their employers and then jump to Jack. But what about the unemployed members or those with independent practices? It's absolutely fine for these last two if they introduce members to if they introduce clients to Jackman for a fee. Therefore, the blanket violation that option B envisages is not correct. Option C most clearly reflects the spirit of loyalty and justice that rule number 1 embodies. And in addition to being the most obvious choice of the given choices here, it's also the only one left after the elimination of choices A and B. This question was about standard 4A, loyalty. Well, there appears to be a lot happening here, so let's take a minute to first figure out what is happening here. Broker has introduced a cheaper, no research, pure execution brokerage service. Invest Today Asset Management has some clients who only need the pure execution, no research brokerage service and have mandated Invest Today to use only pure execution brokers for their accounts. The fees of these execution only brokers, including this new broker, are all comparable, and therefore there is no reason why Carter should not be able to use this new broker for his execution only clients. So choice A therefore appears to doesn't appear outlandish, does not appear wrong, it appears correct. Let's see if choices B and C appear to be more correct than A. Choice B suggests that Carter cannot use the new brokerage service because of the low brokerage expense conditions of his execution only clients. Doesn't make any sense because this new broker is a pure execution broker and does offer cheap brokerage services, so he's exactly what these low brokerage accounts are looking for. So option B is eliminated due to being nonsensical. Option C is also eliminated since it suggests that Carter should drive all business to the low brokerage service, including the business of the clients who want the research-oriented and more costly brokerage services, and he should make up the difference. Carter should make up the difference between the brokerage committed and that actually paid by excessively trading his clients' accounts to generate abnormal amounts of brokerage. That's called churning, and not only does it sound wrong, it also has a name, churning, that ensures that this practice sounds wrong. So with the elimination of choices B and C, A, that appeared correct to us at the outset, remains as our choice of the correct answer here. This question was about standard 3A, loyalty, prudence, and care. Rule number 6, especially the earlier part, the part about if you have it, don't flaunt it, comes into play here. Also, rule number 1 of not doing to others what you wouldn't have them do to you. Rule has probably violated rule number 6 by making some very subjective statements about the intellectual supremacy that the CFA charter bestows on the charter holder. And he's definitely violated rule number 1 by lying, because as we all know, the CFA Institute does not tell anyone that they scored the highest possible marks in any subject, even to those people who actually did. So choice C is definitely out, and assuming that rule did pass the exam in 3 straight attempts, then much as I'd like to stick it to this arrogant, smug guy, we'll have to let it slide. Choice A is incorrect, since the statement of fact, the statement that yes, he did indeed pass the exam in 3 straight attempts, is a statement of fact. So that is not a violation of rule number 6 or rule number 1. The only surviving choice, choice B, is also the most obvious one, since by claiming an achievement he couldn't possibly be aware of, rule is violating rule number 1 and the spirit of rule number 6. Well, the CFA program and My Way rule number 1, and for that matter, the rules of general decency and common sense dictate that someone who pays for something should enjoy its benefit also. Soft dollar commissions are generated by the clients who invest in the real estate fund. As such, the clients should enjoy the use of those soft dollar commissions, not anybody else. And for Stafford to acquire the CFA charter at the investor's expense is just not fair to those investors, because any benefit that Stafford may actually get from the acquisition of the CFA charter and the improvement in Stafford's skills as a result of the exams, that benefit walks out as soon as Stafford walks out of the door, in the sense that as soon as Stafford leaves employment. So choice C is the apparently correct answer in this case. Choice A is wrong, because even if the fund prospectus discloses and authorizes the use of soft dollar commissions, this is overridden by the more stringent requirements of the rules of My Way. Remember, gravity, whether you forget about it or not, will remember you. This question was about standard 3A, loyalty, prudence, and care. This question is about a member's independence and objectivity in the face of lavish entertainment and hospitality thrown his way by a third party investment manager. Rule number one requires Long to ensure that no undue advantage accrues to the third party investment manager both at the conference and afterwards. And minimizing the conflict of interest means that Long should accept the minimum possible benefits from the investment manager. The least beneficial option, the one where Long accepts the least favors from the investment manager, appears to be option A here, since both B and C involve Long accepting more and more hospitality and entertainment both for himself and for his colleagues. So we will select option A here as our correct choice. This question was about standard 1B, independence and objectivity. Well, ideally, Andrews should never have heard of this news and should have carried on trading oblivious of this upcoming corporate event. However, now that he does know, rule number one requires him to adopt a course of action that least affects other market participants and members of the circle of life. Coming to the choices, there's no guarantee or certainty that the news will become public the next day, so choice A appears to be out. Notifying all managers of his firm of this upcoming corporate action is to basically hand them and their clients an unfair advantage over other market participants, since this news is not public and is material in nature. And to trade on it is to go against the very spirit that rule number one tries to instill. So choice B is also a straightforward elimination. What we're left with, and what also seems to make the most sense in this case, is choice C, because while choice C does seem to acknowledge that yes, the firm is in possession of certain material non-public information, it has the advantage of freezing the firm's beneficial positions in the stock as at that moment. And these beneficial positions will remain frozen until the material non-public news becomes material public news. So in this case, choice C appears to be the least likely course of action that will fall afoul of the requirements of rule number one. And we will go with this as our choice in this question. This question was about standard 2A, material non-public information. Well, this one's easy. The most flagrant violation of rule number one, the course of action that's most likely to mislead and mistreat people, that's most likely to lure them into thinking that something big is up with local bank while in fact it's not, is choice B. Both of the other choices are or would be statements of fact, so there's nothing wrong with making them public. This question was based around standard 2B, market manipulation. Well, rule number 1 operates here, and the test is whether or not prospective investors are being misled by ABC Investment Management. Choice A may or may not be correct, but that is irrelevant since it is not mentioned anywhere in the question that the firm claims GIPS compliance to begin with. So I think we can safely discard option A. Option B can also be discarded since effectively it condones a violation of the firm's own publicly disclosed methodology of performance calculation. So after the elimination of choices A and B, what remains is C, and that is what we are going to go with as our choice of the correct answer here. This question was about standard 3D performance presentation. Well, going by first principles, work that has been done for the employer and that has been paid for by the employer is properly the property of the employer. It's commendable that the employee went to the extent of using their personal time and equipment to do official work, but once the employment was over, the property should have been returned to the rightful owner, or permission should have been sought from the owner to retain the property. Therefore, the correct choice here appears to be A. B and C, choices B and C appear to be eliminations because there's nothing in any rule, particularly in rule number 1 that appears to operate here, that says that employees cannot work on official problems or official projects on their own personal time or using their personal equipment. And certainly there's nothing in any rule that says that whatever work that employees do on their own time or using their own equipment becomes the property of the employee. So with B and C being eliminated and A appearing to be the most logical choice as well as the only survivor, we are going to select choice A as our answer here. This question was about standard 5C, record retention. Quinn seems to have fallen foul of both rule number 1 and rule number 6 here. And in my opinion, he's fallen more foul of rule number 1 than he has of rule number 6. I mean, glorification of the virtues of the CFA Charter is one thing, but to actually claim the CFA Charter while not being eligible for it is quite another. So the fact that there for sure has been a violation takes option C off the table straight away. Now, between choices A and B, one is a question of subjectivity, while the other is a question of fact. Quinn may or may not have burnished his investment skills by having made it to level 3. But what we do know for certain is that Quinn has just sat for the level 3 exam. We do not know whether he's cleared it, and we do not know whether the CFA Institute has announced his name as a CFA Charter holder. Until we do, he is not eligible for the CFA Charter, and therefore we are going to pick certainty over subjectivity here and select option B as our choice of the correct answer. This question was about standard 7B, reference to CFA Institute, the CFA designation, and the CFA program. Hmm. Well, this appears to be a fairly straightforward violation of rule number one. Hart has placed herself at an advantage over other investors by acting on material non-public information that other investors were not privy to. The announcement of the results for the quarter will most likely lead to a surge in the share price of Mega, thereby increasing the value of the retail ETF. And Hart, by refusing to play on a level playing field, has therefore fallen afoul of rule number one. And the only choice that reflects that here, is option A. This question was about standard 2A, material non-public information. Well, first of all, third-party preparation providers are honest, God-fearing, hard-working folks who give it their all and ask for very little in return. So let's hear it for third-party preparation providers. Okay, that probably also takes option A off the table. Um, well, as we all know, the CFA Institute does not release past exam papers, and therefore, for a candidate to disclose specific areas of the CFA exam that received considerable attention is to tilt the exam field in favor of future candidates. Um, Therefore, Park has violated the sense of fair play embedded in rule number one, and that violation is most clearly reflected in choice C here. This question is with regard to standard 7A, conduct as members and candidates in the CFA program. Well, Paper's job as a fund manager was to show investment performance. So, if he was using the fund performance with the permission of his prior employers, then that is not a violation of any rule of my way, but simply a very reasonable thing to do. So, let's eliminate option C here. Now, I could go with either of choices A and B, with the choice between them resting on whether he in fact claimed the entire fund performance as his own or not. The question does not clearly state this one way or the other. So, one can, for the sake of exposition, one can say that if he had clarified that he was part of a team of fund managers and had a hand in the success, Paper would not have violated any rule or any code or any standard, and hence choice A would prevail. If Paper had misrepresented himself to his prospective employers by claiming the entire fund performance as his own, then that behavior would fall afoul of rule number one, due to Paper having dealt less than truthfully with his prospective employers. So, in that case, option B would have prevailed. This question was about standard 3D performance presentation. Well, rule number 1 and rule number 2 seem to operate here. And I must say that for all practical purposes, soliciting donations for the golf program through her newsletter does not of itself appear to be an impediment to Townsend's functioning as a fund manager or investment advisor. Neither does this seem to draw a distinction between the clients who respond to the donation call and those who don't. For all practical purposes, as we can see in the question, there is no distinction in Townsend's treatment of her clients on the basis of whether they do donate to the golf program or do not. So, if there is no difference in treatment and there is no impediment apparently to the investment performance, then one cannot really say that the call for donations has caused Townsend to fall afoul of rule number 1. As far as rule number 2 is concerned, that relates to confidentiality and never ratting your friends out. And since Townsend has approached the clients herself, she has not shared their contact information with the golf program, then the client's contact information is still confidential, and Townsend has not breached the precepts of rule number 2. When both rule number 1 and rule number 2 are not violated, the only option that we can go with here is option A. Well, these last couple of videos showed the application of the what to the how, and we tried to apply the rules of my way to a broad spectrum of practical investment situations. This was an effort to deepen and sharpen your understanding of the rules of my way and also how they are used. And as you might have seen, it's not that difficult. The rules themselves are fairly intuitive, easy to relate to, and even easier to remember. And the key lies in practicing to the point where you are able to automatically parse a question into the issues involved and are automatically able to realize the line of thinking to follow and the correct rule from my way to call upon. Just remember to be honest with yourself in your understanding, be thorough with the practice, keep it simple, and you will be just fine.
This is youshallpass.com saying thank you, have faith, you shall pass.